Welcome to the Real People, Real Business Show. My name is Stephanie Hayes, and I'm a business strategist who helps mature entrepreneurs design their wealthy exits. Whether that means building an asset-based business model for an eventual sale or simply taking yourself out of your business while enjoying its continued growth. I love to speak with like-minded entrepreneurs to share their real stories and the gritty details on how they've navigated their own way through. On this show, you won't hear about the glamorized entrepreneurship journeys that you see online, and you won't be told how to make six figures in 6 weeks. Instead, you can expect to hear real, vulnerable, and inspiring stories you can relate to that have helped create the foundation for each of our guests' businesses. Today, I'm so excited to welcome Melissa Widner. Melissa is the CEO of Lighter Capital, the pioneer and leader in revenue-based financing for tech startups and scale-ups. Melissa has a deep understanding of both the entrepreneur's journey and the role a funding partner can provide. As CEO, Melissa led 2 companies to successful exits, returning over a 10 times return to her investors. She was the founder and CEO of Silicon Valley-based 7 Software and the managing director of NAB Ventures, the VC arm of the National Australia Bank, where she led the bank's investments into high-growth fintechs, including Lighter Capital. Melissa's also the co-founder and chairperson of Sydney-based Head Over Heels, an organization that supports women entrepreneurs running companies with high growth potential. Welcome to the show, Melissa, and thanks so much for taking the time to share your story today.
Great. Thanks so much for having me, Stephanie. It's great to be here.
So we have lots to talk about. I would really love to just start from the beginning with you and tell me a little bit about the journey. So you've led a couple of startups, at least a couple of startups. You're an investor, you are leading revenue-based financing. Tell me everything. How did you get here?
Well, so I am very entrepreneurial. I was like an entrepreneurial kid, had businesses when I was a kid and in college, had a hair accessories business. So I was always quite entrepreneurial. I ran a company right out of college that was a turnaround company, and then went to business school, did a summer internship at Goldman Sachs and sort of learned about like technology companies and more about financing, and then started an enterprise software company in my second year at business school that ended up having a successful acquisition where it was a company called 7 Software, and we were acquired by Concur. I then had a nice exit, so went into the angel investing and then became a venture capitalist with a fund in the US, and moved to Australia with an Australian husband and got quite involved in the Australian ecosystem, the whole startup ecosystem here, which has grown tremendously over the last decade. Most recently, I was the managing partner of NAB, National Australia Bank Ventures. And at National Australia Bank Ventures, we invested in Seattle-based Lighter Capital, which is the pioneer, as you said, and leader in revenue-based financing for B2B SaaS companies. So I got involved in that company at the board level, and then in 2020, I took the CEO role. So I've been running the company for a little over 2 years now. And you also mentioned I'm the co-founder and chair of Heads Over Heels, which is a Sydney-based organization, or Australia-based organization that helps female entrepreneurs. And the way I got here to where I am now is I just love spending time with the most fascinating people on the planet, which are startup entrepreneurs. They are a different breed. They are the most interesting people. And, being able to work with them and help them is just a privilege. So that is how I ended up here at Lighter Capital. At Lighter Capital, we can talk about what we do, but we've provided over 1,000 rounds of financing to over 500 companies, and most of them, B2B startups, B2B SaaS companies.
To help our listeners understand more about the model, maybe you could tell us a little bit about how revenue-based financing works and how it's a bit different than, more typical kind of venture-based financing.
Yeah, so venture capital is what everybody hears about and everybody reads about, and that's what's celebrated, big rounds raised and unicorns being formed. But it's a tiny, tiny percentage of not just companies out there, but even technology companies out there that go down that venture path, that want to go down that venture path and give away equity and control, or that are even eligible to go down that venture path, because venture capitalists are, they're unicorn hunters. They're looking for companies that can become large businesses. They're okay with a large loss rate, meaning it's fine if 8 or 9 of 10 of their companies fail, as long as they get that one hit that does really well. I mean, that's just the business model. So, but there's a lot of companies out there that aren't on that path necessarily. Their TAM, their total addressable market, isn't big enough where they would ever become a unicorn, but they're still, good companies run by really good people that need growth capital. So that's where Lighter comes in. Backing up a little, as a venture capitalist, I spent the better part of 2 decades as a venture capitalist. And I say, venture capital, being a venture capitalist is a great job, because you also get to spend time with the most fascinating people on the planet, startup entrepreneurs. But you're in the rejection business, and you're saying no probably 99 times for every time you say yes. And, that's hard. You're constantly, not telling people their baby's ugly, but constantly saying no. And I remember I pitched a lot of VCs when I was an entrepreneur. You remember every pitch you give. And, every no, rejection is never easy to take, even knowing that, there's a 99% chance the answer is going to be no. It's never easy. But on the Lighter capital side for our company, we fund every company that meets our investment criteria. And our investment criteria is transparent, straightforward. There's very little subjective measurement that goes into it. It's data driven. We look at a company's numbers, and we can tell whether they will be a fit for our financing or not, and if they will be a fit, at what price. And we're able to let potential applicants know within a day or two if they are a fit, and potentially get money out to them in a week or two. So it's a much simpler process than going through a venture round.
Right. And for those who aren't as familiar with it, it's also different than, going in and leveraging yourself and getting a loan or some, type of leveraged equity to get you through, right? This is where I'm assuming Lighter has an option to buy.
So no, Lighter is a loan. So basically it's a revenue-based financing.
Yeah.
Is we provide a loan, and the payback that the company pays back is a percentage of their revenue until the loan is paid off. So the way it works, depending on the duration of the loan, but let's just say it's a really short-term loan, you might borrow $1, and in a year you'd pay back $1.10, and you'd pay back monthly payments until it's paid back. If you're borrowing money for longer, say it's 3 years, you might borrow $1, and over 3 years pay back. It depends on the risk, but payback, call it $1.35, but it's a fixed amount. So you would know that, I've taken this dollar to build my business, and I'm going to pay back $1.35. And the payback is a percentage of cash collected revenue, a small percentage every month. And it's usually, the percentage is also set, but it's usually under 10%. But say it's, 6% of your cash collected revenue every month until that $1.35 is paid back. And what's great about that for both Lighter capital and for the entrepreneur and for the business is that our interests are really aligned. Because if the company has a month where there are low cash collections, they don't have an onerous debt burden to service. If a company's revenues really decline, they don't have this big debt payment to make. They've got 3 years to pay it back. And if there's a lot of variability in their cash collections in those 3 years, it doesn't put, the company's able to service the loan.
Which makes things so much more accessible, having been through the process numerous times. Yeah. It's there's a lot of risk, and there's a lot of anxiety, there's a lot of stress in going out for capital. And I think this model, revenue-based financing, the model in general, is making it a lot easier for the founders who don't necessarily meet that criteria to get some capital and get some injection. Now, do you ever look at any of these founders and look at them as potential acquisition targets? Are you still involved in the investment space?
No,
No.
so we provide funding and then we provide help. So
Okay.
we don't take any control, we don't take any equity, we don't take warrants, we don't take any board seats, but we provide capital and then we provide help. So some
Awesome.
companies use help from us a lot. Some just take the capital and go on their way. But we have a big community among our entrepreneurs. We put on a CEO summit. We have CEO groups so they can really learn from each other. And we also have perks, discounts that are offered to our companies. Like one of the biggest one that gets taken up is a $25,000 AWS credit. A lot of our companies are AWS customers. So it's one of the biggest areas where we provide help is when a company does want to go on and do a venture financing round. So, like I said, I was a venture capitalist for a long time. I'm very well connected in both the Australian ecosystem and then also in the US. We have Silicon Valley Bank, who is a investor in lighter capital. So when a company does want to go on and do a venture capital round, we'll help them with their deck often, and we help them with warm introductions, which is really important. We can't get them funded, but we can at least get them warm introductions into venture capitalists when and if they do want to go down that path.
Yeah. Can we go back to the beginning? And I just want to talk to you a little bit about you started up Seven Software in your second year.
Mm-hmm.
And so you recognize the opportunity. And can you tell us a little bit more about that business and how that grew? And, I'm really curious around the story because you were quite young. And a lot of times when people are right in that stage, like I remember being, second year and really not knowing what my options were and really being unaware of what I could do. And I wish I knew what I know now back then, but how did that evolve for you?
Well, before I went to business school, I had run a manufacturing company, and that I did that for 5 years. It was a turnaround. It was a 40-year-old company, had a great return for the owner, the investor, got a 15x. We sold the company on his investment. So I did have experience running a business before and running a sales team and a P&L. But when I went to school in Silicon Valley, I went to business school at Stanford, and I learned about technology companies. And I spent the summer working at Goldman Sachs in New York and saw technology company valuations. This was when it's been a pretty bull market for a long time, but this is kind of at the beginning of things really heating up. And had this opportunity with somebody who was my co-founder, who was my boyfriend at the time, but he was at Microsoft, and he's my husband now, by the way, but he was at Microsoft. And he had created this product there for internal use called MS Market that was to automate procurement. And the company saved Microsoft. They would tout it as saving Microsoft $35 million internally by automating procurement, by taking a lot of the manual labor out of just processing a purchase order. So it was obvious that there was a demand for this. Microsoft was not an enterprise software company at that time in terms of they were mostly focused on consumer applications. So they had no business. They had no interest in productizing this. So the opportunity was pretty obvious that, there was a demand for this. So we started that company. I was the CEO. My co-founder was the CTO, got some, bootstrapped it, got some early customers that helped fund the early days, got some early angel money in. And then before we did a venture round, we were acquired.
And you said you were acquired by Concur.
Concur, yeah.
Yeah. And so how did that go? So did you stick around for a little while? Was there a transition out? Yeah.
Yeah, it's interesting. I talked a lot. This is a conversation I have with a lot of our lighter capital portfolio companies, because a lot of them do go on to be acquired. And what I've noticed is that over the last decade, especially the time required for the founder to stay with the acquiring company seems to have increased.
Yes.
So it's now seems to be 3 years is what everybody's asking. And I had to stay with the company, I think, for 11 months per my agreement. And my co-founder had to stay for 2 years because they were more interested in, the technologist. But
Yeah.
it was, I would say, Concur is a great company. It was just it's painful
Yeah.
11 months if you're used to, doing things and making things happen. And I see that a lot of times when companies get acquired. You just kind of have to go sit there with the big acquisition company and, not necessarily having an impact. But other times companies are acquired and the acquirer leaves the company alone and lets them run with it. I think that those tend to work out, better.
For the short term, at least. I know we used to run a consulting company in the integration space, and so we would do big enterprise integration. And there's a lot of need for that kind of work with mergers and acquisitions because you've got this CFO that acquires a company or is part of the acquisition, and is all of a sudden, the minute that happens, the new CFO is responsible for all of the financial reporting and all of the numbers for the whole organization. So the sooner you can get the data and the systems integrated, the better. And so we were always kind of on the edge of that circumstance, I guess, and have seen lots of those kind of play out. And back then it was always like the year that the old founder hangs around and then kind of moves on and that sort of thing. Yeah. So you stuck around for 11 months, and then what happened?
Then I started doing some angel investing, which was fun. And it's great getting out back there in the entrepreneurial community. And I started, I'm just trying to think of the timing, how much longer it was. I think it wasn't, probably within 7 or 8 months, I didn't think I would get a job right away, or that wasn't the plan to go back and work right away. I had a brand new baby at that time. At that time he was probably 1 year old. I was having a baby at the time I was selling my company. So, but I ended up going to a venture capital firm in Seattle where I worked for quite a long time, for over a decade.
And then, you were somehow back to Australia.
Yeah. In Australia. Yeah, exactly.
Yeah.
My husband's Australian.
Yeah.
So I say I had a verbal prenuptial agreement to live in Australia someday. So
I don't know that I'd be unhappy about that.
No, it's not. I'm not complaining. I spend about half the time in the US. I've been spending more of the time the last 2 years in the US than in Australia, but it is not a bad place to live.
No, I would imagine not. I think that there's probably a lot of similarities to kind of where we were or where we are in the world. And maybe Sydney and
the water.
The water. There's even isn't there Canada Bay? There's Canada Bay in Sydney, just an area. Yeah. Anyway, so you've had you've had your feet in both the startup world and the venture world, and it feels like you're kind of in a little bit of both right now, at least from the financing side. So the one thing that I see with a lot of startups, and like you, I've been in the startup world for a very long time and been an entrepreneur mentor and, building accelerators and that sort of thing, incubators. But I think that a lot of small founders don't know that funding is accessible to them, and they think they have to go through a huge venture capital exercise. And I think a lot of, I think what you're providing to founders is a lifeline that they didn't know that they had, because if they can't go for money, then, or they don't want to go for money, or they're scared of going for money because it's such a big undertaking and, there's so many rejections. It's a hard thing to endure.
Yeah.
Very, yeah. And so how are you finding that there are more of these kind of smaller founders that are realizing they can get that kind of support now, and that they can move through to, growth without having to take on that exercise?
Yeah, look, all things equal, it always makes more sense to take debt over equity, unless that equity is coming with so much help it's worth, giving away, the control you might be giving there, or the equity that you're giving away in your company, that upside. So equity is really expensive for a growing company. But
For
if you're
sure.
getting a commensurate amount of help for that, for giving away that equity, it could be, absolutely worth it. So, if you're getting, just an investor, and that's going to change your business. That doesn't happen often, but that can happen. And also you should take equity over debt if the debt is going to be onerous to service and potentially put the company at risk. So, you don't want to take debt on that, if you have a hiccup, you might not be able to service it. And it could, create, if there's a bunch of financial covenants, or, a typical bank debt has pretty strict financial covenants that make reporting requirements can be quite onerous for the company. So, this type of funding is typically going to be preferable over equity. Now,
Yeah.
the limitation with this type of funding is lighter capital will provide up to 4 times MRR for smaller companies, and up to 6 times MRR for larger companies, because it has to be an amount that we can get paid back with a very small percentage of revenue over 3 years. So take a company that's doing 100,000 a month in revenue, we can provide them up to $400,000. But if you're a company doing 100,000 a month in revenue, and you need $10 million to grow to your next, to hit your next milestone, then you're going to have to go down the equity route.
That's a really different situation for sure, right?
Yeah. Most of our customers, so in terms of the size, Lighter provides capital funding rounds for anywhere from 50,000, as small as 50,000, up to $4 million. So it's quite a broad range. The average customer, when they take their first financing round from us, it's around $450,000. But we have several that take under 100,000. But we sort of, with over 1,000 rounds of capital deployed, we've seen everything. But I would say the most common scenario is a company that has been bootstrapped, or maybe had a little bit of angel financing, and now they've kind of figured out what they're doing and who they're selling, what they're selling and who they're selling it to. And they realize if they bring on another salesperson or create another product, they can actually move the needle. So they're ready to invest there and want to take in some capital to grow. So that's a very common, common use of our funds. We also have companies that are further along, where there's one founder wanting to buy out another, and they don't want to go down and venture route to get funding for that. They don't want to give up control, but they need to get some capital to buy out either early investors or a co-founder. And what we're seeing today, a lot of in this market where, valuations have declined a lot in the last year, is we're seeing a lot of already venture-backed companies who are doing well coming to us for funding, because they don't want to go out there again
For another round.
One, spend a lot of time, potentially do a down round or a flat round, because a year ago you were able to raise at a lot higher valuation than you can today.
Yeah. I grew up in I'm from the technology sector, and I grew up in the .com era. It was a different world,
it was
right?
A different world, right?
Yeah. And there was, people were throwing money at everything, and we were working, incubating little companies. And so we were always at the mercy of, whatever venture capitalist was giving us money. And half the time they just wanted to give us money so they could write it off, and they wanted us to fail, right? And so it gets really tricky, right? And I actually own a software company right now that is right at that inflection point, where I know that we can't grow unless we have some more money. And we're all in the range of our 50s, and we're trying to make a decision. And so we thought, oh gosh, we should sell the business, or we should, but we know we can't go any further. So you reach that inflection point where I think like a little bit of revenue-based financing would work well for us as an option that just maybe would have been available. Like, we've been in business for 12 years, and 12 years ago, I don't know that would have been available to us. No. So it's becoming really interesting to sort of get into this world, because we were entirely bootstrapped, great, profitable business, and, big sort of solid clients, but what do we do? So like, I
Yeah.
think there's a question there around when as a business do you know that it's time to look for some money?
Well, you shouldn't take money if you don't know how, well, if you don't have a very specific use for it, because
Yeah.
I mean, equity is the most expensive money, but debt is also expensive. If you're borrowing $1 and paying $1.10 over a year, or $1.35 over 3 years, that's, you have to have a justification for spending that 35 cents so in terms of how it sounds like you might be looking at it, if we took your company as an example, are you looking at a founder buyout, or are you thinking that there's, some other areas that you'd want to invest in?
Well, I think it depends. I think it depends what the terms would be. I think it would depend on, what the options are that are before us. But revenue-based financing is just kind of come across our desk as an option, and it's one to explore. Whereas before we were really looking at, do we just sell the business? So I think that there's that pressure point that most of these businesses are feeling when they realize they need to start going for money. I think a lot of startups kind of, you start up a business, it's in the early days and you're like, oh, the things, I'm going to go do these pitches, I'm going to be on Dragon's Den. And like, you just don't want to if you don't have to, because I've seen it so many times and it's hard. Right.
Yeah.
But then I think that a lot of founders are still like, founders don't necessarily have a business education. And so I think a lot of founders are still kind of like, well, maybe I should ask for money and I don't really know why yet. And I think it's smart to sort of stay operating in the business until like I know we've been in business for 12 years. I know now we're at that point because there's pressure. I try to bring in new business. We probably can't deliver on it in the time that we need to because our resources are constrained. So that, like, those kinds of things, without a doubt, I know this. 10 years ago, it would have just been sort of maybe we should ask some money. I don't know why, but maybe we should ask for some money.
Yeah.
So,
well, I mean, it sounds like that's a really good candidate, because if you're saying, look, we know how we could deploy money and generate more revenue as a result, but if we had the money now, we would do it today and generate the revenue faster, then that's the perfect use of, not just our money, but any type of investment.
yeah. And when would you advise somebody to actually go for venture money?
Well, so if you are trying to build a company, if you are going down that unicorn path, and also if you're going down a path where you are going to need to raise a lot of money to get there, which there aren't a lot of companies. There
Big
are some,
biotech startups, that sort of thing.
Even most technology companies. There aren't a lot of companies, worth over $1 billion. That there are some examples, but there aren't a lot that didn't raise a lot of money to get there. So if it's a company where if you're trying to dominate a space and you are going to just have to go for broke and raise a lot of money, then the venture path is probably the only one, with some very rare exceptions. So you've now there are times to get on that path, and we have so many examples in our portfolio of current and former customers who used our money to get to a point where they could really pick their venture investors, because they had a lot of traction before they were going out. And we have just sort of example after example, but one that comes to mind is a company out of New York called Flip. They used to be called Red Route. They're great company that does helps semi-automate customer service, not all of it, but they automate parts of it. So they can really help companies scale their customer service capabilities without putting on a lot more bodies. But they took money from us when they had $1 million in revenue, And they did a couple rounds of financing, got up to 3 million in revenue with our money. So without any dilution, went from 1 million in annual revenue to 3 million, and then did a venture round. So same exact story with Style Arcade, run by a great entrepreneur, Michaela Wessels out of Australia. She took money from us when she had just 1 million in revenue and went and did a venture round, did I think probably 3 rounds from us, and then did a venture round when she had 4 million in revenue. So if you think about, I don't know what her valuation was at the venture round or what it would have been, but if she had raised it, say, when she had 1 million in revenue in venture capital, if she had raised venture capital when she had only 1 million in revenue, and let's say, she could get a valuation of 10x. So she would have had a valuation of $10 million when she was raising, but instead she went and raised when she had 4 million in revenue. And if you assume that same 10x valuation, she's raising now at a $40 million valuation. So she was able to get there without dilution. So able to, instead of raising at 10 million, raise at a $40 million valuation. And again, I don't know what, I'm just putting a multiple on her revenues. I don't know what the valuation is, but to the extent that you can grow, the more you can grow without dilution before you have to take that venture round. If you do have to take that venture round, the better the outcome is going to be financially for the entrepreneur and for the early angel investors, if there are any, when there is an eventual exit.
Yeah, no, I love that. Can we talk about Heads Over Heels?
Yeah, love to talk about Heads Over Heels.
Tell me more.
So Heads Over Heels was founded in 2010 by 3 of my co-founders and myself in Australia. I was fairly new to Australia at the time. And we just got together and we weren't seeing anything really moving in terms of like more women getting funded, more women growing companies. Something really needs to be done. And this was before Lean In. This was kind of before it became, a topic that was much more widely discussed and sort of in terms of like, there just aren't a lot of women out there growing big companies and getting funding. Thankfully, that has now been, it's a lot more widely discussed and there's support around it, but in 2010, there wasn't a lot happening there. So we started Heads Over Heels with the idea that we would support women entrepreneurs running companies with really high growth potential, and the way we would support them would be by getting them connected to senior business leaders whose connections could help, move the needle for these companies. And it goes back to, I think, about when I started 7 Software. I can trace a lot of good things that happened to the company and even to the eventual exit that we had. And it had to do with, being, having a specific introduction or connection made, at the right time. So the thesis behind Heads Over Heels is that women are good networkers, but in general, they don't have the same access to the types of connections you need to really move a business forward that their male counterparts do. And again, that's in general, that's not the case with every female, but you think about those things you need to move your business forward. A lot of times it's access to financing and having those networks for access to financing, access to strategic partners. So what Heads Over Heels does is it's a selective process to become a Heads Over Heels portfolio. First of all, it's a not-for-profit. There's no fee paid by the entrepreneur. This is funded by great sponsors. And if you're selected to become a Heads Over Heels portfolio company, you can present to our group of what we call connectors. And these are very senior business leaders who are just willing to open up their networks. So you might pitch and say, this is what my company does, and this is what I'm looking for. I am looking for introductions to banks because we sell to banks, and we'll have senior people in banks as our connectors, and they'll say, I'll make the introduction. So they can't do the sale, but a warm introduction is so hard to get, and it could be something you never get, and it could be game changing. So after we've now done this for 12 years, and there's just story after story and evidence or example after example of how this one introduction made a big difference and potentially the difference in a company's life. So we're really what Heads Over Heels is about is trying to give women equal access to those networks. And our connectors are men too, and then so it's not just women. The CEOs are just women, but our connectors are men and women.
Yeah, I love that. And is that just based in Australia?
Well, yes, it is, but we we found out in COVID that our format works really well over Zoom too. Everything was in person before, but Zoom works really well. So we actually had an event that was focused on the North American market in last March, and we're doing another one this March focused on the North American market. So I will definitely
Keep
invite
me
you,
posted.
Stephanie.
Yes, I would
Yeah,
love to
absolutely.
attend.
Yeah, it would be
Awesome.
great. And
Awesome.
it's for some of our CEOs here in Australia, but we're to get them in front of, people that have deeper connections in the North American market. So specifically for companies that are looking to go to the US or Canada.
Amazing. I mean, and that is truly what is needed. I know there are a lot of memberships you can become part of and pay for and that sort of thing. And I have been in those, and I think there are very few and far between are the ones that are highly effective. So I think that, what we need is exactly what you've talked about. I know that any of the businesses I've started in the past have only grown through collaborations and partnerships, and being able to align our work with that of other partners who are, who understand it and who can introduce us and bring us forward. So I love that that's the work that you're doing. Before we finish up, there's one question I always ask all of my guests, and you've been a business owner. I mean, I think we could probably talk for 3 more hours, but you've been a business owner, you have been a venture capitalist, you have been, you're leading this nonprofit, you have been all over the place. What's the difference between, what we hear out there in the online business world or in the business world in general, and what's actually real about running a business? Where do you start, right?
Yeah, where do you start? I mean, it is absolutely exhilarating. The highs are very high, the lows are very low. I think I'll maybe change your question a little bit, if that's okay.
Yeah, sure.
So one of the things that we believe about, or generally believe about entrepreneurs, is that they're big risk takers. And that's actually not the case. They might be bigger risk takers than the average population, but big risk takers would be like, I don't know, derivatives traders, or, those are big risk takers. I mean, entrepreneurs in general are, taking more calculated risks, but what entrepreneurs have in common is that they have more, or what they have that to a much greater degree than the general population is they have high confidence in themselves. Typically, to go out and start a business, you have to, because you're going out and doing something that is, the odds are you're not going to succeed. But they're much more comfortable working in a world of ambiguity than the general population, because you have to be, you have to make decisions without having all the data, and you're never going to have all the data, and you just have to be comfortable living in that world of ambiguity and have a high confidence that you're going to be able to navigate it. So I think that that's something that probably doesn't get talked about very often.
That's such an amazing answer, because you're absolutely right. I have worked with a lot of entrepreneurs that are, I wouldn't say are overconfident, but and actually do get crippled by some of the lack of confidence. They still do it, but that tolerance for ambiguity is absolutely what we all possess. And the longer that you need things to be certain, the slower you're going to go.
Yeah. Right. And And the other thing is a higher tolerance for failure, or a lower fear of failure. I wouldn't say no fear of failure. I think you'd have to be inhuman. I mean, failure is the worst thing. And it's every time I embark on something new, that's my biggest fear, even if it's just going to be like a reputational failure. We all talk about like how, in the Valley, failure is celebrated. I mean, not really, nobody wants to fail. Success is much more celebrated, but I think that entrepreneurs do have a higher tolerance. Obviously they have a higher tolerance for, potentially failing, because you'd have to.
I do a lot of work around innovation strategy and innovation management. And, one of the sort of theatrical claims about innovation is that you always want to celebrate failure. And I think that's just goofy. I think what we need to do is just change what we define as failure. Like it's just good information, right? So you tested something, you tried something, it didn't get the result that you wanted. Well, now you have more information, right? So I always try to I'm one of those people that just never experienced that, like the fear of failure or the fear of being judged. I don't know what,
Really?
maybe I
You
should
never
hear more.
experienced it? No?
No, I mean, not in the way that it's like crippling. I know it's a possibility, and
Mm,
I don't want it, and I don't like
yeah.
it, but it's never held me back, right?
Yeah.
And I think that's one of those entrepreneurial tendencies, is like when you can stop making it about you. And I think that's the one problem a lot of entrepreneurs face is they personalize it a lot, right?
Yeah.
So it's
Right.
not really about you. It's just, there were other decisions to make, and you can still make them. And this is just all a long continuum of more information, right? So
Yeah.
I think I love your answer, because it's it's very, very true. And that ambiguity is needing to be certain is gonna absolutely hold you back. Love it.
Yeah.
Awesome. So we're coming up on time. We're going to wrap it up, but can you tell our audience where they can find you or connect with you?
Yeah. So lightercapital.com, spelled exactly LIGHTER, capital.com. If you are interested in finding out if you might qualify for our funding, you can go lightercapital.com/apply. It takes 45 seconds just to fill out a little bit of information, and that will say, look, it looks like you might qualify for our funding. We also launched something recently, and Stephanie, we can put this on your website for people to find it, but it's our evaluation calculator that it's a question we get asked probably almost more often than any other question, is what's the valuation of my company? These are entrepreneurs, a lot of them that aren't out there getting their valuation validated by VCs, but would like to know. So we put a valuation calculator up there.
Love it. Oh, great.
Yeah.
We'll put all of those links in the show notes. And I think that this is an incredibly valuable resource. I know the people that I'm working with are looking to create an exit down the road. They're not necessarily at that place right this moment where they're ready to exit, but they want to create a business model that makes their business more valuable, so that an exit in the future could be viable for them. So I think becoming educated and having access to tools like you have provided, I think, are going to be incredibly valuable. Awesome. Well, thank you so much. We're going to wrap it up. I'm so happy that we had the opportunity to chat with Melissa today, to hear more about how her businesses came to be, her experiences along the way, and what the future entails for her. And thank you for tuning into this episode of the Real People, Real Business Show, where we get the real entrepreneurial stories and journeys that you can relate to. The show notes, resources, and links from this episode are available on my website and social media platforms. If you've enjoyed today's content, I'd love for you to give us a review on whatever platform you're on to help us share these genuine stories with an even bigger audience. Until next time, keep building, keep dreaming, and keep being real.